Hi guys, how are you doing? So today we are going to discuss capital adequacy ratio, CAR, you can call it CAR, a very important indicator in the banking industry or financial institutions in general. So capital adequacy ratio. So you can imagine the ratio, right? This ratio as like capital adequacy, right? How adequate your capital is, right, to uh, support your assets, right? And especially for the financial institutions, we call it risk-weighted assets that we're going to see. Okay, so let's go straight into our materials today. Okay, so the importance of capital adequacy, right? Again, this is something that will always be measured and supervised by the Financial Services Authority, by the central bank, and other prescribed authorities uh, that have the relevance to protect the financial sector, right, or the pillar of the economy, because financial institutions are basically the pillar of the economy. Because when financial institutions are in trouble, or when the industry uh, doesn't work properly, then the economy is also uh, threatened by the possibility of stagnancy, or even worse, it might lead to the collapse of the economy. So we'll see the importance of capital adequacy here. So the first one, see here, absorb unanticipated losses and preserve confidence in the financial institutions. So this is quite unique for financial institutions because we see the name here, capital adequacy. So the word capital carries a relatively different meaning for financial institutions compared to that for um, manufacturing, services, and the common types of firms. So you see, for the manufacturing, services, and other types of firms, we define capital as all kinds of financing provided by investors. So you can imagine, right, the word investors, right? Who are our investors? So people who provide, people or institutions that provide financing and ask for something in return. So they're asking for return, right? For the provision of the funds. That's why you could imagine. So almost all items on the right side of our balance sheet are capital or components of capital. This is for the manufacturing services or common types of firms. Right? So this could be imagined easily. Right? So almost all items on the right hand side of our balance sheet can be defined as capital. Almost all, right? Except some non-capital items. You can watch my video on the capital structure and also the cost of capital to get more detailed discussion on capital, but here we will just review a bit, right? So almost all items are capital, right? Because they're provided by investors. Investors are people who provide money with like requirement, right? With required return. Okay, so this is for again the common types of firm. But here for financial institutions, uh, we only define capital quite narrowly or quite more specifically. Right? We have equity. So the definition of capital for financial institutions revolves around equity and a little bit for the like subordinated debt, right? Subordinated liabilities. Right? So the definition of capital, right, for financial institutions is more limited, more specific, uh, and consequently, the amount would be uh, more little, right, in terms of proportion compared to the whole items on the right hand side of our balance sheet. Okay, so that's the main difference. So the definition of capital for financial institutions is more limited or more specific, right? So it revolves around equity plus a little bit liabilities, especially the subordinated debt. Okay, so we come back here. Can imagine the unanticipated losses and preserve confidence, right? If we have higher and higher capital adequacy ratio, capital adequacy ratio means capital divided by assets, right? And we'll see later the definition of assets would be risk-weighted assets. And again, the definition of capital for financial institutions would be more limited to equity and a little bit subordinated liabilities. So the higher the ratio, um, like the higher the confidence in the financial institutions will be, right? Common sense, right? Because now we have a high proportion of capital or equity plus a bit liabilities compared to the assets. And usually this is quite small, right? The ratio, right, based on Basel requirement will be around 8 to 10.5% that we are going to see in a little while. Okay, and protect uninsured depositors. Right, the depositors they bring in money as depositors and also other stakeholders, maybe our bondholders, commercial paper buyers, and so forth. Right, so the higher the ratio, the higher the protection because again you see the ratio here. This is the proportion of our capital to assets. Okay, so the third one is to protect insurance funds and taxpayers. So you have insurance funds, uh, maybe a bank or a financial institution is selling, let's say is buying like insurance policy, or maybe credit credit spread forward, right, or credit spread option, right, or something like that. So uh, by having a higher level of capital adequacy ratio, and actually the insurance funds and even taxpayers' money could be protected, right? We could protect the insurance company that sells maybe something like credit spread forward, credit spread option, or direct insurance. Also taxpayers, because if something happens to the financial institutions, most likely the government will come to intervene, right? Because there's a famous terminology, too big to fail, right? Because financial institutions are too big to fail. So most likely the government will use taxpayers' money to bail the financial institutions out. Okay, and then protect against increases in insurance premiums. So as you know that if you maintain a higher ratio, higher capital adequacy ratio, then the premium to be paid to the FDIC, like Federal Deposit Insurance Corporation. Of course, we have different names in different countries. We have the name like LPS in Indonesia, right? Or FDIC in the United States. So the higher the ratio, the lower the premium that a bank has to pay, right, to the FDIC. And also, this will affect the branch funding and other investments to provide financial services, right? Because uh, if the required ratio goes down, then you can imagine here, uh, like you are allowed to have like a lower level of or lower amount of capital in proportion to your assets, right? Relative to your assets. So you can imagine this will affect, excuse me. So the ability of a bank to, you know, really disperse credits, right, to um, other institutions and other clients. Okay, so capital adequacy and TARP. This is very important. Important program in early 2009 when the financial crisis or the banking crisis hit the United States, and the government decided to uh, come up with this program, right, the Troubled Asset Relief Program in early 2009 by President Obama. So the top program, the government, you know, essentially bailed out the banking sector or the actually the whole industry in general, but most of the top recipients, most of the recipients were banks, right? So except for some big companies like General Motors or um, uh, some automakers, some insurance industries, but almost all of them were financial institutions. Okay, so see, more than 900 banks were bailed out at that time. You could imagine 900 banks. So there's no joke, right? Uh, Even in some countries, with the liquidation of 16 banks could lead to the collapse of the regime. Right? But in uh, early 2009, there were like 900 banks being bailed out by the program. Right? So the government was injecting the money as preferred stock, right? In the form of preferred stock. I see here more than 200 billion were allocated, right? 200, almost 250 billion dollars were allocated. And by 2015, 236 was paid back, was repaid already, plus 34 billion in dividends and assessments. So this was quite a dangerous period of yeah, dangerous period of time in the United States in between 2008 and 2010. And again, it's more than $200 billion. Okay? So here's the thing, right? During the TARP program, there were a lot of requirements by the government. So I remember at the time that they came up with the TARP program in February 2009. But by April 2009, uh, there had been several big banks or big organizations that chose to quit the program. Why? Because there were a lot of restrictions. So you can see here, no compensation for senior management to take excessive risk, and then for dividend payment or stock repurchases, those had to be approved by the SAR. At the time they called it SAR, right, or the supervisor or a supervisory body, and also if top executive had received bonuses or stock options or anything based on inaccurate information or false information, then there was a clawback provision there, clawback. So if they were caught, they had to repay, or they had to pay back the bonuses and options or anything. Right? Prohibition of golden parachutes, right? In for example, severance pay, some M&A activities there, right? The provision of golden parachute or something like that. And I think the cash compensation should not exceed like $500,000 per year. So you could imagine that usually the top executive by that time received a lot of money, right? Millions of dollars. at least for the cash compensation, they would receive maybe more than definitely more than 2 or 3 million, right? Excluding the stock rewards and stock options and some other bonuses. But according to the requirement for the top recipients here, the cash compensation should not exceed 500,000. So there were a lot of restrictions, and that actually incentivized big institutions, big businesses to quit earlier because they were not happy with the requirements, right? They wanted to quit as soon as possible so they could return to the business as usual, the big compensation and also things without restrictions, right? The practices. Okay, so now we'll see some technical things here. So capital and insolvency risk. So uh, capital adequacy ratio is basically ruled by the Basel Accord, or the regulation comes from Basel Accord, and here we have the Basel Committee for Bank Supervision, BCBS in Basel, or Basel, right? So Basel Committee for Bank Supervision. So this was, I think, initiated in 1970s, but the first accord, right, the Basel, the first, I think, was uh, officially launched in 1988. So this was a period before, even before the financial crisis of 1998, right? So 1 decade before. So Basel the first basically um, revolve around credit risk only. And this is understandable, right? Because if you're talking about the capital adequacy, but the solvency of a financial institution, credit risk is the most inherent risk, right? The most, the embedded or inherent risk in a financial institution's operation. I could imagine easily a credit risk. I think it's I think that was the only uh, big picture of uh, the capital adequacy ratio measurement. Right? But again, in 1998, we had a severe crisis, right? A severe crisis in Asia and also uh, Russia, or the some parts of Europe, right? In 1998, uh, then the committee realized that there was an important uh, factor, right, called market risk, especially for the trading book that could impoverish the a financial institution's condition rapidly, right? Okay, so after 1998, actually Basel the First was somehow revised a bit, right, by now incorporating market risk into the capital adequacy ratio measurement. Right? And then Basel the second, so Basel two, so this was launched actually in 2004, but I think the final version was finalized maybe in 2008, right? About 2008. So with the emergence of Basel the second, so we added operational risk also into the capital adequacy ratio measurement, right? The capital, we call it capital charges. So now we have three, right? We have three sources. Um, the credit risk, right? This was from the beginning, right? Credit risk, and then market risk, and operational risk. And then further in 2008 to 2010, the crisis hit, especially in the United States first, right? The banking sector. And again, this required some revisions again to the Basel Second Accord, Basel II Accord. So From 2009 onward, uh, there were a lot of like versions of Basel II or Basel the second. That's why we call the revisions as like Basel two and a half. Okay, Basel two and a half. And while waiting for Basel the third, that was actually planned to be effective on January the 1st, 2019. However, this is delayed or rescheduled because of the unreadiness of many financial institutions in many countries. So this would be delayed to January the 1st, 2022. Right, so Basel the third. And again, before Basel the third, we still adopted Basel the second with some revisions. That's why we call it Basel two and a half. And then Basel the third, uh, again, will be fully implemented on January the 1st, 2022 onward. And with the Basel the third, most likely there would be another addition of component, which is a liquidity risk. Right. So far we have three components in the capital adequacy ratio measurement, right? The credit risk, market risk, and operational risk. In the Basel the third, we might see addition of liquidity risk. Okay, here so capital. Again, for financial institutions, the definition of capital is narrower, right? Again, it is about equity and a little bit subordinated liabilities or subordinated debt. Okay, so here's the thing, right? Market value accounting versus book value, right? So market value and book value, and of course, if you want to be more accurate from time to time, then we'll prefer market value accounting, right? So market value of like equity recording or something like that. So you can imagine for the equity, book value of equity would be based on the uh, amount of common stock registered, right? And then the amount of the uh, paid in capital in excess of par value the first time the stock was sold, right? And then I think the market value component in the equity, in the conventional accounting would be like something like retained earnings. And then if you buy back some stock, right, you have the paid in capital in excess of par value for the treasury stock. And so quite limited items, right, for the limited items that use market values for equity. So if we are going to change the value, right, from book value to market value, then it will take a lot of effort, right? And there's some uh, potential drawbacks here. Difficulty of implementation, because now if you want to implement a market value, like the value of your equity, then you have to use the market cap, right, or market capitalization on a stock exchange. So the implementation would be quite uh, like tedious, and you require a lot of effort from your employees, from your executives. So you have to spend, or you have to allocate a lot of people just to maintain your recording, right? That's not really good, right? So we are wasting resources. So volatility of earnings would be higher as well, because now uh, you're using the market value, right? So market value, you can imagine if you measure uh, anything like market to book ratio, as the market market value of your stock or your market capitalization would be quite volatile, because uh, it depends on many things, so many factors, internally and externally in the capital market. So volatility would be higher, and this will bring like confusing signals to investors as well. So it's easier said than done basically, because conceptually you would love to have the market value accounting, but in reality there will be a lot of difficulties and confusion that would be created by the market value accounting. And also financial institutions will be less willing to accept longer term asset exposures, right? Because you can imagine volatility of the values will prevail, right, from time to time. Because if you invest in a long term asset, uh, the possibility of a change in the value of the asset would be higher if the maturity or the duration of the asset is longer as well. I see based on the duration method and for example, the asset valuation technique, we know that the longer the term of the longer the maturity of an asset, the higher the price fluctuation will happen for every change in interest rate, for example. Right? So this will create more fluctuations in on our balance sheet. So this will create the uh, less willingness by the financial institution to finance or to lend to longer term projects. Okay, so we'll see an example here about market value accounting. So this is the use of we have long-term securities that we hold, and then we have long-term loans, right? We have uh, liabilities, core deposits, and so forth, and we have our equity here. Now, see, we experience what's that? The deteriorating clients, right? We see the deteriorating loan performance, right? Because of, I think, the uh, inability by some of our borrowers to repay uh, their loans, right? That we have given some time ago. So now the market value of the loans has dropped, right, from 20 to 8. So what's happening here? What has to suffer first? Of course, is the equity, right? Equity has to suffer first because of the decrease or the declining value of long-term loans. So you see, this is the basic basic work of the business, right? Okay. So equity holders will always receive something the last. Like if something happens, something bad is happening to the company, the equity holders will have to bear the consequence first, right? So this is I think the reason why equity holders or entrepreneurs uh, uh, are a higher risk profession, right, compared to uh, employees or executive or yeah, other types of stakeholders, right? So again, equity holders have to bear the loss first before the creditors. Okay, but if we are using the book value, right, the book value system, so when actually the market value of the loans drop to 8, this will be reflected later, right here, because we couldn't see it right away, right? Because we didn't use the market value accounting for recording equity, right? Because you can imagine again, uh, the equity that we have is basically consists of your common stock, you have your paid in capital in excess of par value, right? And then you have retained earnings. You might have a treasury stock, and you might have paid in capital in excess of par value for the treasury stock, right? So these two items are basically recorded at book value, right? So only some items could immediately reflect the real situation in the market. So using book value, uh, we could not catch this effect immediately, right? But if we use the market value balance sheet, then immediately we know that the stock price has declined, right? Because of that, and market capitalization of the stock on the stock exchange has dropped, right? So we could immediately reflect the this situation into the equity. But using the book value again, we couldn't immediately manifest the declining value of loans into the change in equity. Okay, so we see there are three pillars, right, in Basel the second, and this is continued with Basel the third, simply with an enhancement. You see the word enhance there. So just in Basel the third, the BCBS uh, just wants to enhance, right, to strengthen the pillars. Right? So first pillar is minimum capital requirements. So this is basically the capital adequacy ratio or CAR, right? As of or until the Basel the second implementation, okay, we had three items or three sources, right? Credit risk. This has been inherent from the beginning, and then market risk, and then operational risk. Right? But with Basel the third, we might add the liquidity risk. Right? So what is the emphasis of Basel the third? Uh, the BCBS wants to enhance the CAR measurement and management. Right? So and the second one, supervisory review. Supervisory review. So this is to enhance uh, the institutions, right? Both inside uh, inside a financial institution and also at the country level, right? So supervisory review, like stronger audit committee, risk committee, right, on the board of directors, right? And the third pillar talks more about the external institutions and rules. Right, see here, rules for disclosure, capital structures, exposures, and capital adequacy. Right, so rules, right, and also the second one would be the market discipline. Right, so with stronger disclosure, right, more accurate disclosure uh, of what capital structure, of risk and capital adequacy information, this could create a market discipline, right? Bad news would be uh, responded by the market, right, with lower demand of the stock, demand for the stock, and consequently lower stock price. I could imagine, and of course, good news will improve the stock price because that creates good information, right? So the disclosure will help, right? Will lead to market discipline. So again, there are three pillars here. They don't change for Basel the third, but only with enhancement of all the three pillars there. So the capital requirement, capital adequacy ratio, and then supervisory review, especially inside the company as well, the audit committee, risk committee, and also the at the country level with the prescribed authorities. And the third one is disclosure, right? Regulations on disclosure that could improve the market discipline. Okay, so we have talked about this, credit risk, market risk, and operational risk, and we'll see each of them. So for the credit risk, uh, we have talked about this, right? Can watch my videos again on credit risk. There are two parts there. Uh, credit risk for an individual loan and credit risk using a portfolio context. So we have standardized approach and also internal IRB, internal ratings based approach. And then market risk, uh, yeah, we have made a video as well on market risk, right? So the use of uh, FAR, right? Expected shortfall, and the official method ruled by the Basel Committee. That is the partial risk factor. And the operational risk, right? Operational risk. We'll see also today that in the Basel the third, we're using SMA, right? So the standardized measurement. So we don't use we of course we can use it internally, but the official method according to Basel the third is SMA. So we no longer use the basic indicator and also standardized and advanced measurement approaches uh, that were used by Basel the second. Okay, so now we're going to see technical and some examples of estimation. So we have several ratio here. So the most general ratio is called leverage ratio. The more most relaxed in terms of the asset calculation, right? See here, tier one capital divided by total assets. Right? Total assets would be on and off. So you see the denominator here is uh, not adjusted with risk weights that we are going to see in a little while. Okay, so the denominator is simply total assets or total exposures on and off balance sheet. Okay, so we have now here tier one capital, tier one, and we have the most basic tier one capital is set one, common equity tier one. So this is the core, right? The most basic uh, uh, capital, right? Most basic what's that definition of capital. So what is set one? Capital, sorry, common equity tier one. So this is a book value of common equity plus minority interest, right? Minus goodwill. So quite limited here. So common equity tier one. So this is the again the core or most basic definition of capital, right? So common equity tier one, and then to estimate the tier one, this is simply the set one capital plus additional tier one capital. So you can see here additional. Yep, this is and the set one. You see, is based on the BCBS uh, definition. Right? So common equity, retained earnings, accumulated other comprehensive income, and then common stocks issued by consolidated subsidiaries of the bank and held by third parties, like what minority interest, right? So minority interest again means if we have a majority ownership in a subsidiary, and this is substantial, then all of the subsidiary's assets would be uh, included or incorporated into the financial institution's assets. However, we know that the claim on the assets is not fully possessed by the financial institution, right? But uh, some proportions of the assets are claimed by other investors, right? Other stockholders. So we have to admit that fact by including minority interest on the right-hand side of your balance sheet. But it's sort of liabilities, but not debt, right? Not borrowing, but it's part of liabilities, so-called liabilities. Right? Okay, so minority interests and have less goodwill and other adjustments applied to the calculation as ruled by the country, right? And then we have so this is set one capital. If we add set one by the additional tier one capital, then we will get the combination will be called what? Tier one, right? So we have the additional tier one capital that you can check also on the BIS and BCBS website. Okay, so we have set one plus additional tier one, we get the tier one. What about tier two? So tier two capital includes loan loss reserves, right? So loan loss reserve, you have the reserve in especially in a period such as this, right? We have a lot of financial institutions have to relax their collection, right? The payment collection because it's ruled by the government to help, especially the small and medium enterprises, for example. So there will be a lot of loan loss reserve, by increasing loan loss reserve, and then various comfortable and subordinated debt. Subordinated debt, see here, this is a keyword here. Subordinated debt is included as tier two capital, right? And also other convertible securities, right? The convertible debt, convertible bond, for example, right? So this is debt that could be converted into equity uh, on a particular date, right? At a particular price, right? So it's like convertible debt or convertible bond. So we have tier two here, right? So you can check again the websites that inform us on the set one capital, then additional tier one capital, right? And then tier two capital. Okay, so here's some changes from time to time here. So again, Basel the third is supposedly implemented from January the 1st, 29 onward, but again, this again because of the unreadiness of some countries, this has been a bit delayed. So the phasing off of Basel the second is uh, uh, procrastinated a bit to January the 1st, 2022. So see here, tier one capital would be what the set one capital ratio. The minimum set one is 4.5, right? Minimum set one, and minimum tier one is 6. See here, so minimum set one capital is 4.5. Minimum tier one capital ratio is 6, and then minimum total capital is 8. Right, so 6 for the tier one capital, but the total would be 8. Right, so uh, you could imagine, right? Total capital is tier one plus two, tier one plus tier two. Right? So if we could provide all the 8% from tier one, that would be fine, right? So there's no problem. So if the total capital ratio of 8% is fully uh, comprised of tier one capital, that would be fine. But can imagine a situation where your tier 1 capital is only 5, but your tier 2 capital is 3. This is not allowed, right? This is not allowed because your tier 1 capital ratio is below the requirement, right? Below the requirement. So you could imagine, right? So the total capital ratio of 8% has to be comprised of minimum 6% tier 1 capital. But again, if the tier 1 capital is 8% or more, that's okay, right? Because the total capital ratio is entirely uh, consisting of the tier 1 capital. But this situation is not allowed, right? When the tier 1 capital is only 5, but the tier 2 capital is 3. Although in combination, they would add up to 8%, but this is not allowed because the tier 1 capital doesn't fulfill the minimum requirement of 6%, right, according to the Basel III. However, now we have buffer, right? We have the conservation buffer of 2.5%, right? So we could say that the uh, minimum capital adequacy ratio would be around 10.5% in the new system. So again, we have let me draw it here. The set one, right? Minimum set one capital ratio is 4.5, right? So, but the tier one, minimum tier one is 6. Again, you can imagine, right? So the additional, we have additional tier one here, but the total should be 6. So uh, if the set one capital ratio is only 3% and the additional tier one is 3%, this is not allowed, right? This is not allowed because the minimum set one capital ratio should be 4.5%. That's the minimum. But in combination, the minimum is 6. So you can imagine if the set one capital ratio is 6% and the addition is 0, this is okay, right? Or 5 and 1, right? This is okay. Or if it's more than 6, it's definitely fine, right? Or even better. And then the total capital ratio should be 8%, right? So the tier 2, you can see, right? This could be 2, this could be anything. But again, the minimum tier 1 has to be 6, right? And the minimum total capital ratio should be 8. So if this is like 7 and 1, this is okay, right? Or 8 and 0 is definitely okay. But 5 and 3 is not okay, right? Because the minimum tier 1 capital ratio should be 5. Okay, with the total capital ratio of 8%, in the Basel the third, we have a conservation buffer, a conservation buffer of 2.5%. So we could say that with the conservation buffer, we might have to improve the capital adequacy ratio to 10.5%. Right? And then there are two other buffers here. The first buffer is called the cyclical buffer. So if the financial institution uh, is prone to like cyclical effects, for example, financial institution in some area, right, in some regions that would provide more loans in certain periods, right, maybe near to some festivals or some festivities, right? So this has to add at 2.5% additional capital. So in total, it would be like 13, right? 13. If the financial institution is a cyclical institution or is susceptible to cyclical effects. And the second possible buffer, actually the third one, right, if we count the conservation buffer as well, is the SIB buffer. So this is what systematically important bank. right? So if the financial institution is a systematically important bank, then it would be another 2.5% additional capital ratio that has to be maintained. So, uh, but most likely you could imagine, right? The if a financial institution is cyclical, definitely is not a systematically important bank, and vice versa, right? On the other hand, if the financial institution is systematically important, then most likely it's not a cyclical financial institution. So, uh, most likely, uh, this is what these two are mutually exclusive, right? If if it is cyclical, then it's not systematically important, and vice versa, right? If it's systematically important, then most likely it's not cyclical. Uh, so you could imagine now a situation for like a top bank, right? So 8% is the minimum total capital ratio, minimum CAR, right? And then plus 2.5% as conservation buffer. And if this is a really important bank and it is included in the systematically important bank list, then it has to add that 2.5%. So the minimum CAR would be around 13%, right? For a systematically important bank. But for a just a common bank, not systematically important, then the minimum CAR would be 8 plus 2.5, or around 10.5%. And this is the categories according to PCA, right? Corrective action, the PCA here, prompt corrective action. And you see uh, adequately adequately capitalized here. This total CAR, total risk-based ratio, right? So adequately capitalized. Uh, if it's 10% or more, this is called a well capitalized. So again, why does a financial institution pursue a higher, higher level of capitalization? For example, they are only required to have a minimum CAR of 10.5, but they have the CAR at like 17% or even 20%, because if it is included in a well capitalized category, they'll pay a lower premium for the deposit insurance, right? To the FDIC or LPS or something like that. So this is considered undercapitalized if the total risk-based ratio is below 8%. And of course, if it's under 6%, this is significantly undercapitalized. And critically, undercapitalized would be a situation where equity to assets is less than 2%. So it's near to insolvent situation. Okay, so you see here, there are a lot of restrictions as well, right? So if you're well capitalized, there will be no restriction whatsoever, right? If you are adequately capitalized, you have uh, no brokered deposits except with FDIC approval. So you have at least one restriction, right? If you are adequately capitalized, but if you're well capitalized, right, according to the ratio here, we have set one, tier one, and total and leverage ratio. But let's look at this one, number three, the most apparent one. So if you're well capitalized, there's no restriction whatsoever. Adequately capitalized, you have one restriction. That for the undercapitalized, so it's one level below the adequately capitalized category. We have some restrictions here. Dividends must be suspended, including management fees, right? Uh, Capital restoration plan is required. Asset growth you know, has to be slowed down because you are undercapitalized, right? So and so on and so forth. So you can see that the worse the situation, of capitalization you are in, then the more restrictions you will be facing, right? So, of course, as a financial institution, you try to get to like a higher level of capitalization. You pay a lower insurance premium to the FDIC, and you don't have restrictions, right? Okay, and then stress test results in 2009, right? In May 2009, see here, stress test, right? It means that we measure the capital adequacy ratio with some uh, like gloomy assumptions, right? Bad assumptions such as uh, uh, close to crisis situation, right? Bad economic growth, high inflation, uh, skyrocketing interest rate, and some other situations, right? Or worsening exchange rates and something like that. So you could see that in May 2009, some big corporations here, some big financial institutions were required to add more capital, right, as a result of the stress test. Some are not, right? Some are free from additional capital requirement because of the stress test. Okay, so now how to estimate the risk-based capital? So we call it capital adequacy ratio, but uh, based on risk, or adjusted by risk-adjusted assets, right? So we have seen the car, the numerator of the car, right? This is capital assets, right? So we have seen this one, right? The set one, tier one, right? And then tier two, and then total, right? Total capital. Now we are going to talk about this one, the assets, the denominator side, right? So the assets here would be risk weighted, right? Okay, risk weighted. And again, traditionally, assets were only adjusted with credit risk. So credit risk adjusted assets. So you have two components here: on balance sheet items, on balance sheet assets, and off balance sheet assets. Okay. So on balance sheet, of course, these are items that appear on the balance sheet, right? On the assets account, right? Off balance sheet means they have yet to appear on the on balance sheet, but they have the potential to materialize. Right? And of course, it has the potential to not to materialize as well. That's why these are still off balance sheet items. Okay, so let's look at an example here. So we have risk weights here, right? Risk weights still under Basel the second, but it's more or less the same with some of course some changes to the Basel the third. So category one, the weight is zero because these are the safest, right? Safest assets. Right? We have the cash, gold, gold bars, gold bullion, Federal Reserve Bank balances. Remember the reserve requirement that we have to uh, put money into our account in the central bank, right? And some other things, right? So category one, and then category two is like accounts receivable, right? Cash items in the process of collection, and exposures conditionally, right? With some conditions guaranteed by the U.S. government, right? Central bank or U.S. government agency, and so forth, right? Category three this will be mortgages, 1 to 4 family mortgages. Category four, category five, category six, seven, and so forth, right? So we have up to category nine. You can see here, category nine. If uh, you have assets in the form of securitization exposure, in the form of securitized assets, then the weight is 1,250%. So it's like 125 times, right? It's quite dangerous one. So what about if we hold other firms, other firms stocks, right? So we buy stocks of other firms. So most publicly traded equity, the normal one is 300%. That's the risk weight. And not publicly traded is even riskier, right? That's why it's given risk weight of 400%, and in investment funds 600%. Right? What about the mortgages? We saw mortgages here. There's some levels there. Category three, category four, category five, category six. No, three, four, five. Sorry, three, four, five. Let's see here. So if the loan to value ratio is less than 60%, uh, then the risk weight will be 35%. For category one, right? Category two will be 100%. So loan to value ratio means this is the opposite of the down payment, right? So if the loan to value ratio is 60%, you can imagine, right? So you borrow 60% to finance the value of the house or building. It means that the down payment is 40%, right? Of course. And let's see this one. If the loan to value ratio is 90%, it means that you borrow 90% to finance a building, to buy the building. Then the down payment is 10%. So the higher the loan to value ratio, the riskier the loan is, right? One more time, right? So the higher the loan to value ratio, the riskier the situation would be. That's why the higher the loan to value ratio, uh, the higher the risk weight assigned to that transaction or that item. Right? What about sovereign exposures? You lend out money to foreign countries, so it depends on the SRC rating of the country, right? 0 to 1 is the safest. Would be like the United States, many countries in Northern and Western Europe, right? And then second, rating 2, rating 3, and so forth. Right? So uh, the safer the status of the country, the lower the risk weight, of course, right? And also, likewise for foreign banks, if you lend out money to foreign banks uh, in a safer country, then the risk weight would be lower. Okay, so let's see an example here. We have a hypothetical balance sheet here. So the financial institution has its assets and the liabilities and equity. So you got help with this information, right? Uh, the weights for all items. If you are not given this information, then you have to look. You have to find the categories by yourself, right? For example, this one, cash. Cash is category one, right? And then the example, this one, items in process of collection. This is included in what category two? So the risk weight is 20% and so forth, right? Okay, so for the on balance sheet items, they're quite clear. Okay, but this financial institution also has off balance sheet items as follows: 80 million in 2-year loan commitments, 10 million standby LC, and then 50 million in commercial LC. And then the derivative transactions here, fixed to floating interest rate swap for 4 years, and then a 2-year euro dollar contract. So interest rate, what's that? Futures, yeah. Okay, with information about replacement costs that we are going to use later. Okay, and then for the right hand side, you see this here. The example has told you a lot of information, very useful information here, so you don't need to look for the information by yourself there. So tier two, and then we have another tier two, then set one, and additional tier one. And of course, tier one means set one plus additional tier one. So they're tier one, right? And then plus tier two, it will be like the total capital. Okay, so you can see here once again, the definition of capital is quite limited. So it consists of equity plus a little bit liabilities, right? Like subordinated bonds, convertible bonds, and preferred stock. Okay, so let's calculate here. The on-balance sheet assets first, right? So see here, so asset here is credit risk adjusted. This is the first calculation, right? Credit risk adjusted assets. So this has on balance sheet and off balance sheet. Okay, so let's start from the on balance sheet items. Credit risk adjusted on balance sheet assets. So we just need to multiply, right? It's quite easy. Here, all the amount here is multiplied with 0 because the risk weight for category 1 is 0 and so forth, right? So this would be multiplied by 20, right? Multiplied by 50%, multiplied by 100%, and this one multiplied by 150%. Right? So we'll get this is the from the on balance sheet items, right? The on balance sheet assets. So we call it what? Risk adjusted on balance sheet assets, and this is only adjusted with credit risk. Okay, so 764.5 million. This is again the weighted average, right? So this is what credit risk adjusted on balance sheet assets. Okay, so 764.5 million. So what about the off balance sheet activities? We saw in this example here. These are the off balance sheet activities. Right? We have loan commitments, we have LC, we have swap transaction like swap securities, and we have forward or futures transaction here. A simple example, it has like 5 off balance sheet items. So let's deal with the off balance sheet items now. So the off balance sheet items could be everything, could be anything, right? The contingent claims. So these are the items that have not materialized, right? Have not happened, right? On your balance sheet, but they have the potential to materialize. For example, you give loan commitments, right? You give loan commitments to many clients. So you promise to stand ready to lend them money if they want to execute the contract, right? Or you have LC, right? It's like guarantee to an importer, or maybe you give a guarantee to a project, right? Like uh, performance bond or something like that, right? Or you have like derivative contracts. You have derivative contracts like forward or futures, swaps, right? Option or something like that, right? So they might not materialize, but they have the potential to materialize on the balance sheet. That's why we call it off balance sheet items. Or you're fighting in the court, right? You're having a dispute with a counterparty uh, at the court. So if you win, you get money, right? So this would be uh, considered a off balance sheet item as well. So let's see this calculation now. The first part of the off balance sheet items are about commitments here, right? Non-derivative, right? Non-derivative contracts here. So we have like loan commitment and LC. Okay, so uh, here's the thing, right? We have the conversion table here, right? So conversion table, what is the risk weight? What is the conversion? We call it what? Conversion factor of uh, the what's that? The commitment or LC. I see. Sell and repurchase agreements, so repo. Right? Sell and repo uh, or assets sold with recourse. The risk weight is 100%. Right? Also, the conversion factor is 100%. Right? Direct credit substitute standby LC 100%, performance related standby LC 50%, and so forth, right? So let's look at one by one here. What is it? 80 million 2-year loan commitment. So 2-year loan commitment. Uh, which one is it? I think this one. Unused portion of loan commitment with original maturity of more than 1 year. So this one, 50%, right? The conversion is 50%. What about the second one? Direct credit substitute standby LC. Yeah, this one, 100%, right? Direct credit substitute standby LC. Uh, the third one is commercial LC issued to a US corporation. So commercial LC, I think this one. Okay. So we've got the table here given by the example. So we just need to calculate. So the first one, loan commitment, 80 million, multiplied by the conversion factor that we just saw. This one, right? Yeah, this one. Okay. So we get what, 40 million. And the second one, sent by LC, the conversion factor is, yep, 100%. Yeah. And then the commercial LC has a conversion factor of 20%. Yep, here, this one. Right. Okay, and then we get the weighted average. How much is it? Yeah, of course, you multiply by risk weight, and we assume that the risk weight is 100%, right? Because this is all about the domestic corporations, so you don't do it overseas, you do it in the domestic market. So the risk weight is considered 100% or one, simply one, right? It doesn't change the risk weight. But again, we have to pay attention to the conversion factors for all the items there. So the credit risk adjusted off balance sheet assets, but for non-derivative contracts is 60 million. Right. So if we keep the record there, what was it again? 764 here. So the on balance sheet is 764.5 million, right? And for the off balance sheet, we have two types, non-derivatives and derivatives. But for the non-derivative contract, we just calculated the one for loan commitments and standby LC. So the weighted average value is 60 million. Right? So now we're going to deal with the derivative items. So off-balance sheet items sourced from derivative contracts. All right, so we have several things here. Potential exposure, we have current exposure, and then of course the credit risk adjusted off-balance sheet assets sourced from derivative contracts. Okay, so this is the table to determine the conversion factor, or we call it what we call it, conversion factor here. So you have let's go straight into the contract here. What contract do we have? The first one is fixed floating interest rate swap for 4 years. Okay, look at here. 4 year, fixed to floating interest rate swap. So let's look. So this is related to what? Swap, right? So interest rate contract, interest rate swap. Okay, for 4 years. So this one. Okay, so the conversion factor is 0.5%. 0.5%, right? And then the second one is what? 2 year forward forex contract, right? The euro to dollar contract. The what's that? Uh, so for what's that? Foreign exchange forward contract, right? 2 year contract. Where is it? Exchange rate contracts here. Exchange rate contracts for 2 years. Yeah, 5%. This is the conversion factor, right? So 0.5% for the interest rate swap, and then 5% for the exchange rate of foreign currency forward contract. Okay, so let's see the information again. The notional value, right? Notional value of the contract is 100 million, and for the second one is 40 million, right? Just to make sure that the numbers match. Okay, so 100 million. Now we multiply it by again this one, 0.5% that we just saw, right? And then we get what? 0.5 million. But the information tells us that the replacement cost is 3 million. So it's positive 3 million. So uh, assuming that the counterparty doesn't fulfill his or her promise, and this contract is broken off, and you have to make a new one. I suppose that today you have to make a new contract equivalent to this one. The cost would be 3 million. Okay, so not good, right? So if the counterparty breaks his or her promise, and again the swap transaction ends with nothing because your counterparty runs away or something like that, and you have to replace, or you have to make a similar contract, an equivalent contract, a new but equivalent contract with the previous one, then the cost is 3 million. So total would be 3.5, right? Okay, what about the second one? The notional value is 40 million, and then the conversion factor is 5%. So let's look at this again, 5% here. Okay, so conversion value of 5%, making the potential exposure 2 million, right? So 40 million multiplied by 5%, so it's 2 million. This is potential exposure. Now this is interesting, right? The replacement cost is actually minus 1 million, right? Minus 1 million. So we are saying that if the contract is canceled, right, and uh, this situation requires us to make a new contract but equivalent, right? A new but equivalent contract to the previous one. Actually, we are in a favorable position, right? Favorable situation where we have the what's that, the upper hand of 1 million, right? So favorable position to 1 million. However, due to the conservative principle, we define this as zero, right? Of course, we're saying that if we make a new contract, but equivalent contract, actually we have an upper hand. We'll gain that 1 million. But for the sake of conservatism, this is defined as zero. So instead of 2 plus minus 1, we do this, right? 2 plus 0. So the credit equivalent amount is 2 million instead of 1 million. So again, if you calculate naturally, right, it's 2 million plus minus 1, right? It should be 1 million, right? But for the sake of conservatism, we define the minus 1 as 0. So we assume that we gain nothing if we replicate or we make a new equivalent contract. We gain nothing from that. So the amount would be like 2 million plus 0, uh, thus totaling 2 million, right, for the credit equivalent amount. So we have how much? 5.5, right, in total from the derivative contracts. Okay. And of course, the risk weight is 1 because you don't go anywhere. This is a domestic. Although there are derivative contracts, but you do it domestically, right, within a country. So risk weight is 1. So it's 5.5, right? So we go back to here. On balance sheet is 764.5. The from the all off balance sheet items, non-derivatives is 60 million. We saw it some minutes ago. From the derivative, we would be what, 5.5. Okay, so we have combination now. Now, so we have the combination. Combination would be about what, 800 something. So let's see here. Do you have the total amount? Oh, here, 830, right? Okay, where is it from again? There are two sources, right? On balance sheet, we have 764.5. From the off balance sheet items, we have two types. Non-derivative contracts, we have loan commitments, we have LCs, and the weighted average is 60 million. And from the derivative contracts that we just saw, the uh, weighted average or the credit equivalent amount is 5.5 million. So in total, 830. Okay. So we get here, right, the credit risk adjusted assets. So now we combine the now we can calculate any ratio that you want. So set one, how much is our set one ratio again? So we go back to the set one. Uh, so let me see. Here, the set one. Yeah, only two items here. Okay, so 70 divided by, get the credit risk adjusted assets, right? On balance sheet and off balance sheet assets, right? So 8.43. So is it good enough? So 8.43% for set one. Yeah, very good, right? Well capitalized, right? More than, even more than 6.5. Okay, so what about the tier one? Tier one risk-based capital ratio. So let's look at our tier one. Tier one is set one plus additional tier one. Okay, so it's about what, 80? I guess 80. So 80 divided by 830 is 964. Let's check, right? 964, how good it is. Tier one, yeah, it's more than 8, right? So definitely well capitalized for the tier one. What about total risk? So total risk-based capital ratio is tier one plus tier two divided by credit risk adjusted assets. So let's see. So tier one here, now we plus tier two plus everything here. So it would be around what? 80 plus 25. So it's about 105. So let's check. Yep. Is it 105 or 115? Yeah, I think it's supposed to be 105, right? So it's about 35, but 25, I guess, from the example. Yeah, but anyway, whatever the number we get. So let's assume that this is correct, right? 1386. So let's check. 1386 total risk-based capital ratio. Yeah, more than 10, right? So it's well capitalized. Better than what adequately capitalized, right? It's more than enough, right? More than enough. Okay, so in this example, the financial institution is quite strong with respect to its uh, tier one risk-based capital ratio and also the total risk-based capital ratio. But again here, the CAR calculation is only based on uh, definition of capital divided by credit risk adjusted assets. So we have not included the market risk adjusted and also operational risk adjusted, right, to the denominator. You see here some information about the restrictions, the payout ratio allowed. Right? We saw the restrictions before, but if the capital adequacy ratio is high, okay, let's take this one, more than 13, then there will be no payout limitation, right? No restriction whatsoever. But if it's between, let's say the here, this is a bit, yeah, like normal situation. The capital, so the dividend payout ratio is about 20% of net income. Right? It, what if the total risk-based capital ratio is between 1175 to 13? Then the financial institutions is allowed to pay out 60% of net income as dividends or stock repurchases. And these are important. These are examples of global systematically important bank, the SIB. Remember, the SIB banks have to add 2.5% buffer to its capital adequacy ratio. See some important banks here, like Deutsche Bank in Germany, and of course the BOA, Citigroup, JP Morgan Chase, State Street Bank in the US, and Bank of China in China, and so forth. Right? So Commerzbank in Germany, and so forth. So this one already, leverage ratio. So what's the difference between leverage ratio and the tier one capital. So leverage ratio is measured as tier one capital divided by total assets. This is simply total assets, right? But tier one uh, risk-based capital, risk-based capital ratio is what? Tier one capital divided by uh, credit risk adjusted assets. Okay, see the difference is in the denominator. And for the leverage ratio, the denominator is simply total assets off and on and off balance sheets. But for the tier one risk-based capital ratio, the denominator is credit risk adjusted assets. This one, tier one risk-based capital ratio compared to leverage ratio. Right? The difference is in the denominator. So what about market risk? We have discussed market risk intensively in our previous video on market risk. So please watch again if you uh, want to know more about it. So in the market risk discussion, we try to estimate the additional capital charge due to market risk. So I think you notice that as of this point, we have calculated the CAR as the definition of capital divided by the credit risk adjusted assets. So now we have the second what's that component, right? Market risk. Before we only saw risk, what's that? Credit risk adjusted assets. Now we have additional item, right? Market risk adjusted assets. So how to calculate this one? The what's that? The contribution from the market risk or capital charge from market risk. Please watch the video on market risk again, right? So now we have two components, right? We have the credit risk and then we have market risk. And again, the market risk, if you watch again, so the partial risk factor, the official method, right? The partial risk factor to estimate the capital charge from market risk. And then the third one now, we're going to discuss it now. Operational risk. So again, we have seen two adjustments, right? The credit risk adjusted assets. We have seen the market risk adjusted assets from the previous video, right? The additional capital charge for market risk. Now this one, operational risk, right? So the first method is basic indicator approach that we don't use anymore. So we don't use it anymore. But just for the additional knowledge, we use this one during the Basel II or Basel the second. Right? So see, gross definition of how to define it. A gross income is measured at the as the net interest income plus non-interest income, right? Total income, and the additional capital charge from operational risk is defined as gross income that we defined before, multiplied with an alpha. So what is the alpha here? Alpha or the beta, you can use beta as well. So for corporate finance, the beta is 18%. For commercial banking, the beta is 15% and so forth. So you simply multiplied this beta, the assigned beta, right, according to the industry by the gross income. And again, the gross income is net interest income plus non-interest income. Okay, so we call this one basic indicator approach, and we don't use it. We don't use it anymore for Basel the third. And then yeah, or you can, I think BIA or a standardized approach, right? Yeah, so for the basic indicator approach, we use alpha. For the standardized approach, we use beta, but it's simply equivalent method. And then in the past, we also used advanced measurement approach that we don't use it anymore also. Right? So advanced measurement approach. So let's see here. Regulatory capital requirement, right? So the additional capital charge from operational risk is measured as the sum of expected loss and unexpected loss for each type of event. So internal fraud, external fraud, employment practices and safety, uh, clients' business practices, damage to physical assets, business disruption and system failures, execution, delivery, and process management, or something like that, right? So again, the additional capital charge was this was for Basel II, right? Was measured as the expected loss plus unexpected loss for each event as listed here, right? So these were the old methods or the previous methods used in Basel II. So the basic indicator approach, the standardized approach, and the advanced measurement approach. So now we are using the standardized measurement approach. So this is what we are using for the Basel III or Basel III. So we call it SMA, standardized measurement approach. So first, we define here business indicator components. So there are three components here. Interest. So this is what like net interest income, right? The absolute value of interest income minus interest expense. So the absolute value of net interest income. And the second component is services, fee income, fee expenses, other operating income, other operating expenses. And then the third one is financial component. So the absolute value of net profit or loss on trading book plus the absolute value of net profit and loss on banking book. So there are two books, right, that uh, you can follow also in our discussion on market risk. We have trading book. This is a non-permanent book, right? The items such as for trading securities, right? So it's trading book, right? So you go in and out. So you don't hold the items for permanent purposes. And the second one is banking book. This is for permanent holding. So again, we have three components here. Okay, interest, services, and financial. Okay, now how to compute the so business indicator. So this is supposed to be BI, right? Business indicator, right? So this is what interest component in year T, right? So we find the 3-year average. So 3-year average of each, right? So 3-year average of interest component, 3-year average of the services component, and 3-year average of the financial component. So we get the business indicator as the 3-year average business indicator, right? And once we get the business indicator, we can estimate the capital charge from operational risk, right? So now it depends on the level of the bank, right? Level of the bank. If the bank has this bucket, the first bucket, the smallest, right? Smallest level of bank, so between 0 to 1 billion of this. The average 3-year or 3-year average business indicator is between 0 to 1 billion. Then the capital requirement or additional capital charge from operational risk is 0.11 times the business indicator, and so forth, right? So suppose we have the largest level of bank here with the business indicator the 3-year average business indicator of more than 30 billion, then the additional capital charge from operational risk would be 6.34 billion plus 0.29 multiplied by the business indicator minus 30 billion. So we get certain amount, right? So again, what is the purpose of calculating this one? This is to calculate the additional capital charge from operational risk. So now we have uh, three adjustments, right? Credit risk adjusted assets, market risk adjusted assets from the previous video, and this one is the operational risk adjusted. Now we have seen three of them, right? One more time, the risk adjust credit risk adjusted that we saw throughout this chapter, right? And then market risk adjusted that we saw in the previous video, and this one on this slide is the operational risk adjusted, right? So additional capital charge from operational risk, and of course with the uh, risk-based capital ratio, we still have some criticisms. For example, the definition of risk weights. Definitions of risk weights will change from time to time, right? From Basel the third to Basel the fourth someday, right? And here's, I think the second point is uh, uh, quite valid, right? This point is valid because the risk weights so far are based on OECD country risk classification. So based on the, again, developed countries research, right? How to define the risk weight for each asset, right? This is based on research in developed countries, right? In Western Europe, in the United States. Portfolio aspects, you have to incorporate more the portfolio aspects into the risk-based calculation, right? Risk-based capital ratio calculation. And complexity is sometimes excessive. So we have to allocate a lot of employees, a lot of executives to pay attention to the measurement of risk-based capital ratios from time to time. And there are a lot of ratios, right? Not only one. Loan-to-value ratio used for residential mortgages. So again, the definition of the what's that? The risk weight for mortgages is based on loan-to-value ratio. This might not be that accurate because yeah, we simply know about the loan-to-value ratio or the opposite of down payment, but how uh, how risky a mortgage as defined by the loan-to-value ratio is questionable, right? And Pillar 2 may ask too much of regulators, right? So again, remember the Pillar 2 is the supervisory review, both inside the company and also external. So the external uh, supervision means uh, what's that, regulator or regulators role, right, in making the regulations and maintaining the level of playing field, right, to maintain the fairness. So it may be too much, right? Too much regulation could create the inefficiency and also could even create the dark creativity. We so-called dark creativity because you get the loopholes, right? You get the idea of doing illegal things from the regulations, right? Before the existence of regulation, you may not ever think about such a practice, but with the regulation, suddenly you get the idea of what's the thing that could be done, right? Especially the bad thing. For example, if you go to anywhere, you go to uh, maybe a touristic place, right? You go to maybe a temple, right? Old temple, and of course you go to the old temple to for sightseeing, right? To see maybe the sunrise or sunset. So you never think of some like crazy or strange things, right? Until you work at some spot, right? At a certain spot, you see a warning there, a warning that says, "Don't steal the stones. Okay, so suddenly you realize that actually you could try to seal the stores, right? But you see, right, before the warning, before the regulation appears in your mind, actually you never thought of bringing back the stones from a temple, right? But with the existence or emergence of the regulation, suddenly you got the idea that the stones uh, could be stolen, right, if possible. So this is, I think, of course, the drawback of a regulation. So too much regulation, too many regulations would create some negative side effects. But of course, without regulations is also dangerous, right? So either way or both ways have to uh, count the balance between regulations, too many regulations or too few regulations. Okay, so second problem with the pillar two is from the regulator itself. Some regulators are having a big difficulty allocating resources, right? You could imagine like maybe in a particular country, the regulator, for example, the Financial Services Authority, it has to regulate and supervise depository institutions, securities firms, right, insurance companies, mutual funds, right, and finance companies, and so forth. So they have uh, too wide an area to supervise, right, making them or creating a situation where they have a dearth of resources, right, employees and executives to do it, and leverage liquidity and specialness, right, the a trade-off of having more leverage at the positive side of using more leverage and the negative side, of course, and also liquidity, right? Uh, the trade-off of having more liquidity and less productivity, something like that. Okay, so very intensive and interesting topic here that we have seen today. So hopefully it helps you comprehend the capital adequacy ratio, right? Especially for the Basel the third, and of course it keeps changing from year to year, right? Heading toward maybe Basel the fourth in 5 years or in a decade. But the principles are basically maintained, right? The three pillars with enhancement, and of course we see some changes in the measurement methods, right? The prescribed methods by the BIS or the BCBS. So thank you very much for your attention, and see you again in our next videos. Thank you.